Okay, we're diving straight into one of the absolute wildest, most perplexing stories to hit Wall Street in recent memory. In this explainer, we're going to break down exactly how a high flying hedge fund managed to completely blow up in just a matter of weeks. It's honestly a masterclass in how astronomical, out of this world gains can vanish literally overnight when you mix incredibly risky financial mechanics with sudden market shifts. $45 billion. Take a second to just wrap your head around the sheer scale of that number. That is how much money this fund, which was ironically named Situational Awareness, was managing at its absolute peak right before the floor fell out. But to understand how any fund gets this massive and then implodes so violently, we really have to look at the unique mindset of the person running the whole show. This quote really captures the extreme, almost zealous optimism of the fund's founder, Leopold Aschenbrenner. He was absolutely convinced that a massive AI revolution was right around the corner. He legitimately believed that if artificial general intelligence was fully factored into the market, you could see returns of up to 100 times your initial investment. And that wasn't just some casual prediction he threw out at a dinner party. That was the bedrock thesis of his entire multi-billion-dollar fund. Section 1, the 24-year-old billion-dollar whiz. Let's get a sense of who is actually at the helm of this financial empire. Leopold was not your average fund manager. The guy was a legitimate prodigy. He enrolled at Columbia University when he was just 15 years old and graduated as valedictorian. He had incredibly deep, if a bit controversial, ties to the tech elite. He worked at the FTX Future Fund, bailing just before they went bankrupt, and then went to OpenAI, where he was actually fired after leaking a highly critical internal security memo. But despite all that turbulence, thanks to his connections and a massive 165-page viral essay on AI, he launched his fund in July 2024 and instantly raised over $1 billion from top tech executives. And just look at this number. By early 2026, he reported a staggering 439% net gain. A massive chunk of this was driven by a wildly lucrative private bet on the AI company Anthropic, along with some huge public stock plays. He basically quadrupled his investors' money straight out of the gate. But here's the catch. You don't get those kinds of face-melting returns just by picking good stocks. He was using a very, very dangerous financial tool. Section 2, the math of 5x leverage. So how did he actually engineer those returns? And more importantly, why did it ultimately destroy him? This math right here is the absolute key to the entire implosion. So for every single dollar of actual investor money, Leopold was borrowing about $4 to amplify his buying power. That is 5x leverage. You've got your $1 of real equity plus $4 of borrowed debt, giving you $5 to play with in the market. Now, when the market goes up, it is pure magic. A 10% rise on $5 is 50 cents, right? Well, for you, that's a massive 50% return on your original $1 investment. But leverage is a brutal double-edged sword. Here is exactly why 5x leverage caused such catastrophic losses for this fund. If that $5 investment drops by just 10%, the position loses 50 cents. But here is the absolute kicker. The bank that lent you those $4, they do not absorb a single penny of that loss. That entire 50-cent hit comes directly out of your $1 of equity. So a tiny 10% dip in the market instantly wipes out half of your actual cash. If the market drops 20%, your entire fund is just completely vaporized. But honestly, you rarely even make it to a 20% drop. Lenders protect their money using what's called a maintenance margin. They require you to keep your equity above a specific threshold. If your portfolio value drops and crosses that line, the banks issue a margin call. They demand more cash immediately. It is exactly like a bank threatening to instantly foreclose on your house if the property value dips. If you don't have the cash sitting around, they force you to sell off your stocks to pay them back, whether you want to or not. Section 3. The July AI market crash. With that mathematical time bomb taking away, let's look at the spark that lit the fuse in July 2026. Keep in mind, Leopold's entire portfolio was incredibly concentrated in just one single sector, AI. This timeline perfectly maps out the cascade of bad news that triggered a massive slump in AI stocks exactly when the fund was most vulnerable. On July 1st, Meta signaled surplus AI capacity, which hinted at softer chip demand. By mid-July, a Chinese firm announced a rival model. And then the Korean stock market, which was heavily tied to retail debt, plunged. Suddenly, the AI darlings Leopold was heavily invested in, companies like SanDisk and Intel, were plummeting 30 to 50% in a single month. Right in the middle of this chaos, Wall Street watchdogs spotted something incredibly bizarre. Intel posted absolutely fantastic earnings on July 23rd. Wall Street loved the news and the stock popped 8%. But then, the very next morning, the stock inexplicably crashed. It wiped out all those gains and fell another 8%. That is a massive red flag. It was a crystal clear sign that a giant fund was trapped and desperately dumping millions of shares into the good news just to raise emergency cash. Section 4. Margin Calls and Meltdown. So that brings us to the terrifying reality of what actually happens when a highly leveraged fund gets caught in a downward spiral and is forced to exit the market all at once. Talk about a split reality. On July 24th, Leopold sent out this super confident investor letter. He actually called the severe market drop a good buying opportunity and was inviting his clients to pour even more cash into the fund. The guy was literally getting married that same week. But behind the scenes, his financial reality was completely caving in. Just 5 days later, Goldman Sachs, one of his biggest lenders, was on the phone demanding cash for a massive, fund-threatening margin call. When you look at the portfolio's actual structure, you see the brutal, unforgiving math of leverage in action. The fund had about $11.5 billion in actual investor equity, but it controlled $45 billion in assets. Even after factoring in all his long and short bets, he still had a net exposure of about 2x. So when the AI market tanked roughly 30% in July, that loss was massively amplified by the borrowed money. It triggered a devastating 67% wipeout of the fund's actual capital. And this right here is the fatal flaw in his entire strategy, the liquidity trap. To survive that Goldman Sachs margin call, Leopold had to sell off his shares to cover the massive debt, but he couldn't. There simply weren't enough buyers in the market willing to absorb billions of dollars of stock all at once. If he dumped all those shares, he'd crash the price even further, meaning he wouldn't even get a fraction of the cash he needed to pay the bank. He was mathematically trapped in a death spiral. Section 5. The Citadel Bailout. Facing total annihilation and entirely unable to sell his assets on the open market, a highly controversial savior stepped in at the absolute 11th hour. To avoid going completely to zero, Leopold had to find a single buyer for his entire portfolio. Ken Griffin's hedge fund, Citadel LLC, stepped in on July 30th. They executed what's known as a block trade, buying almost his entire public portfolio, roughly $16 billion worth of stock, in one single massive transaction. But because situational awareness was so desperate, Citadel got those assets at a steep discount of more than 10% below market value. The fund technically survived the week, but it shrank from a $45 billion titan to under $10 billion in just 1 month. Now, market observers noted an incredibly fascinating dynamic here, which the source material specifically highlights. Just before the bailout, Citadel Securities, which acts as a market maker, released a memo on interest rates that heavily pressured these exact AI stocks downward. Then, Citadel LLC, the hedge fund arm, swooped in to buy those heavily distressed stocks at a massive discount. Now, they're required to operate completely independently to avoid conflicts of interest, but the optics of one arm pushing prices down while the other buys the dip definitely raised some eyebrows across Wall Street. So as we wrap up this explainer, we really have to look at the big picture. The fund's founder had undeniably incredible insights into AI, securing private deals like Anthropic that were massively profitable. But in the end, it just didn't matter. So we're left with this final burning question. Does having the absolute smartest, most forward-looking insights in the world actually matter if you borrow too much money to act on them? The brutal math of 5x leverage doesn't care how brilliant your situational awareness is. If the market turns, the debt will take everything. Talk about an incredibly expensive lesson in risk when you say,